Moving to the big markets conversation this morning, we have Sailesh Raj Bhan, CIO, Equity Investment at Nippon India Mutual Fund, joining in on Talking Point. Sailesh, thank you so much for your time to us, and always great to have you on NDTV Profit. I just want to get a sense from you on how you're seeing right now the entire, I would say, hesitancy that we've seen in Indian markets starting 2026. All said and done, nothing much has changed. Tariff concerns remain. The only positive in light is that the first set of Q3 business updates show that maybe you will have a good quarter. Does that become the most important factor in your view?
So, good morning. The clear challenge has, over the last 18 months, have been expensive valuations for the market, right? And I think we have seen that 18 months of, I would say, time correction in markets. And in select pockets, we have seen also price corrections, right? And expectations have actually become extremely low because last 4 to 8 quarters have been very weak in earnings. So I think the support from GST, support from the income tax cut, support from general better liquidity in the environment actually should allow for earning growth recovery. And that is our base case, or that is our critical expectations. So when you look at initial trends are just, it's too early to talk about because these are just headline numbers. We don't know yet on what happens to profitability in the quarter and thereabouts. But over a 12-18 month period, earnings from where we stand should get way better. Obviously, this is ex geopolitics and ex what happens in tariffs. But generally, there is a greater sense of earning recovery possibility given the fact that the base has been bad, given the fact that the support has come from policy and all that to enable growth recovery. And I think this will feed reasonably well from an earning point of view. Unfortunately for markets, there is no scope for PE multiple re-rating based on normal conditions. And you need really explosive growth for anything to happen. So earnings will and possibly will be the key source of driving for returns for investors over the next 1 to 3 years is what we think about here.
Growth is at one end, but I'm just wondering, Sailesh, are you right now looking maybe at geopolitical factors as the biggest concern? Are you looking at the budget as the next big trigger coming in, government capex maybe pushing the story ahead?
So all these factors will matter, but I think the most critical is with the low base of earnings where we stand, our earnings should start hitting early double digit. And that is what I think will give you all the drivers for returns in the market. See, budget, for example, a lot of things have always been done even outside the budget to support growth, right? And there is very little which is really left in the budget to really enable, it's more possibly easing more policy and things like that. But there is very little really led to give a push because there's always been a large support to infra. GST has already come about, which obviously has impacts on tax collections, but I think is a structural positive for India. So I think the most important outcome, yes, obviously a year out or so with geopolitical environment normalizes and global growth recovers, which enables our export to recover, it's a big positive or an extra positive. But the existing base is so low of earnings that we should start on its own hitting 10% type of earning growth and maybe feed into 12-13% earning growth the next 4 quarters. And that I think is the factor which will come from low base and all the factors I have earlier talked about.
Sailesh, good morning. Hiral on this side. Interesting take when it comes to the way your earnings is expected to catch up. Now, to add to that, which are the specific sectors or large caps that actually offer that kind of attractive valuation as well, if you have to look at 2026? I mean, you saw the kind of downtick we saw in stocks like Reliance Industries yesterday, HDFC Bank. I know you can't talk stock specific, but do you see opportunities emerge in any of these baskets?
Interestingly, many sectors will see an increased base case of earnings in the next 3 to 4 quarters, right? First, starting with banking themselves should be in reasonable better shape from where they have been in the last 12-18 months. So earning growth there should get better. Select segments of financials like insurance and all are already doing reasonably well, and their earnings after this impact of GST, which is there, should start getting into a better shape 6 months out, right? Then you have, we are possibly already in the face of very weak earning for IT services companies. That should rebound a bit. We are recovering from a low power growth, and power utility earnings have really been flattish. I think that is one space which will see an earning recovery, which is possible. Even expectations in many sectors like pharma and all are actually very, very low from what is really possible in terms of the delivery of earnings which can come from them. So most of these sectors now expectations have come down to 7%, 8% in terms of earning growth, which I think is a lowballing of really the earning potential of these businesses. And I think as you start seeing some benefit and they start hitting that early double-digit kind of revenue growth, I think you should see that sector is also performing well. Even consumption today, consumption discretionary, for example, auto is doing reasonably well, right? But other spaces are not doing well and expectations are running very, very low. Some of these companies could start benefiting from the low base of the last 2 years and should start showing better earnings. So I think overall there is a reasonably broader base construct of, at least in the large cap space, earnings starting to recover. And that should enable, and where valuation expectations, valuations definitely on a relative basis may not be, on an absolute basis may not be very cheap, but I think on relative expectation basis, in a lot of these cases, there has been compression for 3 years, 5 years and all that. And that creates a reasonable base for at least earning-led recovery in the large cap spaces.
So, you're talking about earnings recovery in the large cap space. Which structural themes are you looking at? Because, I mean, your view when it comes to specifically the PSU banking space or even the PSU space, do you think these are re-rating candidates from here on?
Yeah, so interestingly, PSU banking space has re-rated fairly significantly. In fact, in the last 1 year, if you see, they have been very strong performers, right? Our bias today, based on the relative outperformance of the PSU bank space, which has happened, I think is towards large private sector banks, which I think have consolidated. Most of them are actually flattish on a 12-month basis and have consolidated enough, and their outlook only gets better as we move into the next few quarters. So I think the large cap bank private sector space is where I think there is a meaningful opportunity to look out to. Select PSUs, which are leaders in the space, have sensible valuation still, I think, and there is an opportunity. But the broad-based pack of PSUs has done well on the back of strong flows in the mid-cap segment of the market, which these guys generally are present in.
Sailesh, since we're speaking with you at the start of the year, it'd be safe to say equity investments overpromised and underdelivered in 2025 from the perspective of what we saw in other asset classes. And the start of the year seems like you're going to see maybe metals and a lot of other asset classes still promise even more. What are you mentally penciling in for the kind of year that we're seeing?
So interestingly, the market euphoria of the last 12, 18 months, I think, has given away. So that's a reasonably better starting point, right? But it's clearly not that the markets are so cheap that, you will surely have some aspect of a multiple re-rating in the market. I don't think that is still possible, right? So I think our base case is whatever earnings deliver, P multiples remain thereabout, because the geopolitics is actually, we are possibly in the worst of what's happening globally as we see. So I think over a 12-month period, you would get earning-led possibilities certainly exist in the market. You mentioned other spaces like, metals and especially precious metals and all have done very, very well in the last 12, 18 months. I think they have been compressed for a 5-year period. Some of those would have given minimal return in the first 7 years, and then they would have given 3 years return in a very, very short period of time. See, these kinds of bursts of returns are possible in any category, right? For equity markets, that's just been 18 months of flattish market, right? And maybe if we see earnings surprise us maybe in the second half of the coming financial year, and then you might have some surprises or upsides possible there. But purely our base case would be more earning-led returns, especially for the large cap space, and the consolidating market in a mid and small cap space is what we see, at least for the next few quarters.
Consolidating market in the mid and small cap space. Now, among these, Sailesh, I'm wondering what you're finding exciting in terms of thinner slices of pockets, like cables and wires, for example. Within BFSI, is NBFCs now looking better, and maybe private banks will take a backseat. I'm wondering if there are any opportunities like that on top of mind.
So it is, it's a very, very broad market in terms of wherever valuation corrections are happening, there are some opportunities coming about. So they're across different pockets. So today, one of the most underperforming spaces is the QSR space, right? Because haven't delivered broadly in terms of growth. Plus, excessive investment and rapid expansion has created, I would say, a weaker phase of earnings for them. So wherever we are finding weak phase of earnings, because stocks are only correcting where earnings are weak, I think that is where, if surprises come, you have large upside. So these are spaces which are there. QSR is one. Power utilities is another where, for various reasons, it's not been a great year from a power volume point of view. And but I think their valuations are sensible in that area where, investors can look at. IT services is another which is there. And I think where there is enough consolidation, expectations of growth is 0 to 5%. So if there are some surprises there, you can have some reasonable outcomes. And large banks themselves. I think large banks have seen pressure on margins. And I think over a period of time from here on, I think they should get better from what we stand. So their earning visibility is strong, books are good. So these are 4 or 5 spaces where we think there is a better place to deploy capital relative to the other aspects. Also, please understand in the smaller mid-cap spaces, the corrections have been, I would say, only in pockets of the market. So, for example, maybe 10, 20, 30% of small cap space has corrected, right? And I'm not referring to the below small cap market, which might have corrected a lot more. And even in mid-cap, about 10, 15% of the segments have corrected materially to be able to worth a relook from a investment point of view, right? So I think wherever these corrections are happening, they're happening on near-term bad news. So the whole idea is to get a few good ideas out of these type of businesses where valuations are in your favor, expectations are running low, and hence you have reasonable outcomes. You don't have a very, very strong growth also. You have a reasonable outcome. You have benefits coming to the investor. So I think these are 4 spaces which I would want to touch about. Very specifically, cables and wires or any specific very small segment of the market, you may have phases of recovery, but I think generally valuations everywhere have not come off.
Valuations have not come off everywhere. You could see opportunity. Sailesh, your view when it comes to IPOs? I mean, absolutely overvalued. The kind of valuations that the IPOs have demanded in the last couple of months of 2025, it's been exorbitant. People have lost money as well. People have made money. But it's become a tricky situation. How are you looking at 2026 with regards to a couple of big IPOs that could be slotted? And what would you advise investors to do?
See, there is generally a greater amount of interest when an IPO comes because there is a lot of media news flow, there is a lot of research at that point of time, and there is a lot of investment banking activity around that point of time, right? Our idea is to judge them versus what is available in the market for similar quality and similar growth businesses, and look at them from a 3-year kind of an horizon, whether they would be valuable enough for us to participate in. Wherever we are finding that near-term valuations, see, there will be good businesses as well, but if the near-term valuations are 1 to 3 year basis also don't offer any upside, it's very difficult to participate when you have alternatives which are available, which are attractively priced, because like I just mentioned, corrections are starting to happen. So our focus would always be to benchmark them with existing good quality businesses with similar growth potentials, and just make sure that you don't end up overpaying because something is new, right? Because for them, they still have to live the governance market, they still have to live the public market in terms of corporate governance and various other aspects. And any transition we have seen, from private markets to public market does take time unless they are sensibly priced in the market. Otherwise, you have extreme volatility because market needs that time to understand the variability in these businesses, the potential of these businesses, and as also the fragility or the strength of these kind of businesses. So I think our approach is very simple: benchmark them versus existing high quality businesses which we own and which are available in the marketplace today to participate in. And if you're finding better options in the listed space already, we prefer those over the companies which are IPOing. And when you have very good quality business in the IPO market as well, we do review them and take a call. But valuations are central to a lot of our decision
any major IPOs that you looked at
in over a longer term we benefit.
Sailesh, any major IPOs that you looked at in 2025? Now you can, in hindsight, tell us about.
So we would have looked at every single IPO. Yeah. No. So we could have looked at every single IPO in the last 3 years because we have a large pool of public capital which we deploy, right? And we have reviewed them, benchmarked them versus what is available in the market. And in some we have participated, in some we have not. And purely it's a judgment based on what the fund managers and the team and the research thinks about what is a relatively better available, attractive opportunity in the market.
Let me ask you.
And we are open to
let me ask
good
you
quality
a follow-up.
IPOs. Yeah.
Let me ask you a follow-up on that.
Yeah.
Were there any regrets or buyer's remorse in any of those IPOs? And was there any FOMO on the ones that were missed out?
So interestingly, because we go through a series of work internally, right? It takes maybe 1 to 3 months kind of an effort to really get some sense of any business, right? So we have enough and more benchmarking internally done to make sure which we let go and which we participate in. So I think, and also please understand there are 5,000 companies listed in the market, and something or the other we are missing daily. Right? So if we live by FOMO or if we live by anything, it's about as a process, what do we want to follow? What do we want to own? What type of risk we would want to give to our investors? These we have codified ourselves to make sure that, we work within a framework which is right or which is as per the promise to the investors which we are trying to service. So I think large number of issuers or large number of companies coming for an IPO, I think it's not a bad thing. It's just that it takes away a lot of bandwidth. And second, within this, there is a chance that good quality or poor quality businesses get invested in. And that is what we are very, very careful about to avoid them. And also, we don't want to pay excessive valuations to businesses in anything. Even in the listed space, we are just careful, as valuation is an important central theme for us when we create or do sizing in our portfolios.
Okay, so that's where the large funds have an advantage, which retail investors sometimes don't. It's a bit of a hit and miss. So wanted to know that perspective. Sailesh, thank you so much for coming in and speaking with us. Always a pleasure to have you on.